I'm Nolan. Today I'm going to be talking about finances, the coronavirus, and how the global economy is literally grinding to a halt. We're living in a scenario now where basically the world's on lockdown, and so the repercussions or how this affects the global supply chain is going to be immense. The way that market participants and politicians or talking heads are reacting to this is a bit amusing. First, they pretended that the coronavirus was nothing. They were comparing it to kind of flu numbers and saying like, hey, the flu has killed this many people already this year, the coronavirus this. But they were missing the bigger picture about how this affects the economy and how countries can really get in front of this. And what we've seen with now, like in Korea and in China, they've taken extreme measures and basically locked cities down or certain areas like very quickly. And now that seems to be what's happening all around us. Like the world's playing catch up to this. Now, Republicans especially are trying to paint this as like, hey, the left is anti-Trump. They're going to say whatever it is, so they're making it more extreme or they're playing into this panic. Yeah, I don't quite buy that. And also just to remind the Republicans, the economy was never healthy to begin with. So it happened to be the coronavirus, which yes, is a black swan, but it could have been anything that could have really popped this bubble that we're living in. So the basic narrative for the last decade is everything's okay. This is the greatest economy ever even, which is laughable. Or maybe for the slightly more informed, it's we need to invest in the stock market because the Federal Reserve is intent on causing inflation and they're intent on kind of bidding it up, which makes a lot of sense in some ways. But then you think like, okay, a good analogy is like picking up pennies in front of a steamroller. Sure, it might have worked and you might be chasing, this 5 or 10% return on a per annum basis, which has worked out. But then you think, well, there are all these things that could, suddenly cause this to unravel. The Federal Reserve has basically been bluffing all along here. They knew the economy wasn't strong and they knew that they weren't going to be able to raise interest rates to like a historical norm of 5 or 6%. They knew it all along. They knew the precarious state of the economy. They knew that if they were to normalize interest rates, that would tip the stock market over, which is what happened in December 2018. When you directly control the sentiment of the marketplace, which the Federal Reserve does and has done for the last 10 years, you have to be very careful what you say or what you don't say. So it's like, maybe what they say in office isn't necessarily how they really feel, but their hands kind of getting pushed. When you look at Alan Greenspan, when he was in office, he was very like, Keynesian, loose, let's lower interest rates, let's, support the economy. But before he was in office, he was a very libertarian, even gold bug. And now since he's left office, it's the same thing again. He started to talk about, wow, the financial system, I don't envy who's at the helm of the Fed. At some point this comes crashing down, even like, got gold kind of stuff. But that's his true nature. And it's just like, well, people, when they're in office, they have to support the stock market, especially in an election year. So I read an article called The Fed's Bluff Cycle, which has aged really well. I wrote that in 2016. And it's all about, kind of how the Federal Reserve is going to talk up this, we're going to raise interest rates, the economy's healthy, and it doesn't need our support. But basically, this quote, like, you can't handle the truth is what they were saying to you. It's like, if you really knew how we felt about the economy and, we'll be lucky to get to 2.5% or 3% interest rates before we lower, we could literally go in one meeting from like, we're raising interest rates to like quantitative easing, or that's the state of the economy. So people who have had massive amounts of debt or being overly bold or having misplaced confidence in maybe like the S&P 500 or other major indexes have been rewarded, which I think is like, you can't even blame them too much because they were forced into an environment by the Federal Reserve, which basically said, if you don't buy our narrative of everything's okay, and if you have a short position or you're not in the markets, you're just losing money. And that's why Trump was able to get away with tweets like this. And I personally know a lot of people who have made a lot of money in the markets. And of course, I like to discuss this topic, so it comes up quite frequently. And when I ask them what their thesis is or why are they long America, so they give very weak or warm answers, which is basically like, past is prologue. The markets went up the last 10 years basically, or they give you studies from like the last 100 years that say like, averaged out, it's like 8% a year if you just invest for the long haul and stuff like that. And I mean, these narratives do hold, but they miss the key point, which is like you can have massive drawdowns in a single month, like 20, 30%. Or on an annual basis, it could be like a 50% drawdown. So if you're okay, like I said before, like picking up pennies in front of a steamroller, like here 5% a year, 10% a year, and you understand that there's this, precipice and we're sitting on there, and it's like the markets could go either way. Yeah, they could tick up 5 or 10%, but they're not going to suddenly go parabolic, 20, 30% a year. Whereas to the downside, that's very easy, as we've seen in the last week here. So that's kind of one narrative that I hear quite often. Another one is that this is a different kind of economy, which it was for the last 10 years. Like the Fed basically did away with business cycles, or the best that they could have. Now we're seeing the business cycle return with a vengeance, but it was basically from 2009 to, a couple months ago, it was that anytime the market dips a bit, the Federal Reserve is going to come in and kind of prop it up with futures, or just liquidate, lower interest rates, encourage people to spend more money. And that has been right. Like right as in they've been rewarded with that narrative. But if you ask them on a deeper level, like, but do you really believe that? Or if you give them this other scenario where I'm like, well, what happens if we do have a crash again like 2018? Are they just going to come in and bail? At some point, they run out of ammo, which means like they don't have enough kind of options or tools left to kind of handle the economy, and people don't buy that narrative anymore. And I think that's what we're seeing happen now a little bit, where they came in last week, like, firing off liquidity, lowering interest rates, doing whatever they can, but people are kind of like, oh, this again? And then the markets went, like, they hit new lows after that. So is this that kind of, point where they've lost control of the economy? I mean, we won't know. And at some point, if they liquidate enough, like markets will rebound. They're just chasing something with free money. So basically, the idea that business cycles don't exist is what's been rewarded over the last, 10 years here. Will they do? And the Federal Reserve did whatever they could for the last 10 years to artificially suppress interest rates. And when you do that, you don't really realize what happens until it's too late. So it seems to look good where they're like, okay, we've been able to do this, it works, and almost their egos have been inflated to the point where even we won't let the stock market drop, 10, 15%. Like we can micromanage the economy this well. But eventually, if you're in a conversation with someone and you're like, okay, they're making money, they've been right, and I've kind of been wrong with more sound fundamentals, in my opinion, or trying to short the market at times via put options and being long gold, that narrative hasn't really been rewarded until recently. And so the conversation will kind of, peter off into like, okay, I guess like, basically, I would say almost like good luck, or like smile, or just like, okay, well, I guess that's the kind of investments that you like to make, whether it's prudent or not for you doesn't seem to matter, or if the fundamentals are there doesn't seem to matter. And people have been okay with that, obviously, because they've made money, but it's been almost like, tiresome, or it's almost worn people out, where a lot of people, myself included, kind of ran out of ammo to short the markets, or weren't able to kind of hold this narrative for any longer, and almost believing that, the Fed does have some kind of control in this. So the only way to play this is that if your only tool is a hammer, you view the world as nails. So no matter what happens, all it means to them is like, okay, liquidity, liquidity, liquidity. This is how you get yourself out of any situations. And if all the global central banks are doing that together, there's a lot more leeway, right? Because it's hard to call out one country for, stimulating their economy too much when one's, tightening or whatever, like what we were seeing with like Greece and Germany in the early days of kind of the Eurozone crisis, or the Eurozone breakup. With Brexit and stuff, where now we live in a world where all the central banks are like, the hell with sound fundamentals, let's all kind of, devalue against each other so nobody really notices. And that means like China or all the big economies in the world are just stimulating now and lowering interest rates. And in this coronavirus scenario, I think we're going to be giving out money to people very quickly in like the form of vouchers possibly, just to get people to spend. And I think that's going to happen on a global basis, not just in one country specifically, the way things are going now. And we are going to see bailouts in the energy sector specifically. A lot of those like shale drillers, or like in Alberta, like our oil companies, they weren't really profitable at like, $60 a barrel. And now with the ending of OPEC, like overnight, we're at like $30 a barrel. And the end really of one of the biggest like oil cartels that ever existed. So at a time when the global supply chain is shutting down. So I think we're going to see a lot of potential bailouts or a lot of bankruptcies in the oil space at $30 a barrel. Just no one's profitable, and you can't kick the can down the road any further by doing just more drilling or taking on more debt at this stage. We'll see though. I think some of that will be like too big to fail kind of as a sector, and they will get bailed out, a lot of them, but we'll see here. That's going to be brutal for Alberta, where I'm from. I think there's going to be lots of layoffs in the oil patch, and probably bankruptcies as well with that kind of a shock, especially if we stay down here for quite a while, which I think we will. I don't see Saudi Arabia or Russia suddenly like flipping and being like, you know what, like, let's like renegotiate what we were talking about, like, a little bit of a cut to raise oil prices. It's almost like, who are they really targeting here? Is it Saudi Arabia, kind of saying like, hey, Russia, we don't like how you're undercutting us in Europe. We want control of kind of OPEC or OPEC plus members. Or is this a play for them against the shale drillers, where Russia and Saudi Arabia are like, let's finally take out like these kind of annoying swing producers, shale producers that have been alive just because of like free debt. They're not even really profitable. So let's hammer them while the global supply chain shutting down with like overproduction and just undercutting costs on their barrel prices. So the idea that this is the greatest economy ever, of course, is laughable, but it was bought into by the masses. I like to view it or explain it as that the global economy can be viewed as like a heroin addict. He's addicted to heroin debt, and instead of allowing him to withdraw from this toxic substance, we've inflated him with like doubling his heroin dosage, which is like doubling the debt. So when you have a debt crisis like we had in 2008, what's the natural solution? Okay, double the debt, that's going to solve the problems? No, it's just inflating it or kicking the can down the road and making the inevitable kind of crash or come down that much worse. So now we have this sick heroin addict, his immune system's kind of shot, and we're doubling his dosage again. We're upping it instead of allowing him to take like a codeine or like a morphine or a methadone or something that's going to allow him to kind of, this is slightly less toxic, and let's let him withdraw in like a healthy way. We're not letting him do that. So you have this fragile system and immune system, and then you get something like the coronavirus, which just comes in and rocks his immune system here. Like the global supply chain is shutting down. So it's like the heroin addict's body is like, okay, I'm not getting anything right now, and oh, you're flooding me with this like toxic substance. I haven't eaten in weeks. My body's weak. It's like I'm on life support and you're injecting me with this again. It'll feel good temporarily to the people who get that hit or that like free money or bailed out, but in general the economy just gets weaker and eventually like dies or gets killed off by itself. So while it was impossible to predict the black swan event, the coronavirus, which has happened now, it didn't have to be the coronavirus. There were a lot of things that could potentially have come in and disrupted the global economy.
A's, 0. B's, 0. Double B's, 0. Triple B's, 0. And then that happens.
What is that?
That's America's housing market.
So like this scene from The Big Short, which is one of my favorite movies, I think I'm going to rewatch it here this week, is that you had a very, very weak foundation, and that's the kind of state of the heroin addict's immune system, or the state of the economy, when the coronavirus came in here and just like rocked it. So obviously, yeah, we haven't seen this level of collapse in such a short time, or this kind of fear ever in our lifetimes. It is definitely one of the biggest events in our lifetime, and it's changing kind of hourly or daily depending on how close you're following it here. So as Elon recently tweeted, he said the coronavirus is dumb. Wow, that's very deep, or I think it's very almost ignorant, or like, yeah, very callous of him to say that, where people are dying, or just like people are losing their jobs. Like, sure, you have billions of dollars and stuff like that, but not everyone's in that situation. And everything he kind of tweets out is very biased towards his companies or his stocks. So soon it will be like the financial system's dumb. Translation, like, I don't have cheap access to money now, or people are starting to look at the debt on our books, or our stocks getting crushed, we're over leveraged, and basically give me free money to fund my dreams and brain farts. Like, yeah, that's kind of what I get from that tweet. But it's not just Elon Musk in this case, it's the world is being addicted to debt. Like, that's kind of how people think now. So companies or people in general are almost expecting to be bailed out, or expecting more liquidity, not like bad loans or bad banks or bad businesses are going to go under. I think they should. Like, I'm down for that. Sure, there's certain institutions that you might have to analyze and think, like, are they too big to fail, or is this going to set off a domino effect? That should be analyzed, but that should be on like the extreme, unknowns or black swan cases, not just like, this is the playbook. This is what we do at all cases, and people are making decisions based off that. That's a failure of capitalism. Once the incentive structure has been skewed that much, and bad decisions have been rewarded for, up to a decade, people are almost like indoctrinated in this, yeah, supply and demand doesn't matter, everything's okay, and people openly calling for socialism, like the Bernie bros. Like, there's almost this whole new world of people who have grown up or lived through like no real hardships until recently, and life has been pretty good, and they didn't have to kind of understand supply and demand or Econ 101. All that stuff's been chucked out the window. Well, unfortunately for those people, that stuff does matter, and it does exist. Central banks will continue with liquidity here as a panacea. That's all they know, and that's all that really they have access to. Now, how this really becomes evident, or maybe how to trade or invest around this, is eventually, once people stop selling stocks and they're like all in US dollars, that's kind of like, I don't think we're that far off from that. I think we could go a lot lower in the markets, and I think the US dollar could get a lot more overvalued temporarily. But I would almost be looking to kind of trade the extremes of that, because as people realize, like, hey, the US is just as bad as anyone else, the debt, they could even get downgraded, like we saw in 2011, where, Moody's or rating agencies are saying, like, okay, America, you've just been borrowing for too long now, how are you going to pay this back? And it's basically the only way they can do that is through inflation. So now how do you trade that? That's why I call this video the Great Reflation, or part 2 of it is the video that I put out last year on this topic, is saying liquidity is guaranteed, so how do you capture that? And Bitcoin is up, I think, like around 20-30% now on the year. But until last week, it was up over 100%. But then we had that historic plunge where it dropped 40% in a single day. But at the same time, if you liked it at 10K and you believed in your digital gold or the halving or any other bullish narrative for Bitcoin, and you don't like it a lot better now around $5,000, did you ever really believe in that narrative? Yeah, I guess it's weak hands. My other favorite investment is gold and miners. So gold is up about 17% on the year. It hit an all-time high, or not an all-time high, but like an 8-year high at $1,700 about a week ago. And now it's been sold off a bit too, or intentionally kind of suppressed so people don't view it as a safe haven, or it starts to rally too much on a big down day in the markets. But yeah, I'm very bullish on gold. So I think in the short term, people just sell everything when they're scared. But a few good things to do right now would be selling puts on stocks that you would like to acquire. It would be getting exposure in precious metal via selling puts, or buying, gold stocks or gold directly, and digital gold. So yeah, I like Bitcoin at these levels. I bought some more recently, and of course, there's a lot of things that can happen in between gold and gold rallying, depending on how bad or how much this lockdown goes. But what we're seeing now is already gold dealers are selling out of gold. There's already like a spread between the gold futures markets and the physical markets, which there should be, because of one is not a real price discovery. It can be manipulated with leverage and just like 100-to-1 paper contracts, whereas the physical market is literally a barter system. If you go into a store and you're saying, hey, I want to buy this silver ounce for like 16 bucks, and he's like, no, it's 25 today, do you want it or not? That's the real price of what it is, not where you can't take delivery on a futures market. And also gold and a lot of miners and things that will do well in this environment or over the longer term are getting sold via the margin clerk. People are getting liquidated in other things, and they're selling not necessarily what they want, but what they can. Just a quick little note as well is a lot of maybe what I would view as kind of hedge fund legends, or people who have done really well in the space, or who I like the way that they think, haven't really understood the markets for the last 10 years. And some of them have even returned money to clients, saying that in this kind of environment where fundamentals don't matter and the business cycle is being manipulated to this extent, we don't feel comfortable investing in this. Like, we don't understand this. So they return money to clients and basically like bought gold or had a basic cash position. And a lot of those people know that when a big correction happens, that's when you kind of have a reset, or there's a few obvious trades to do there. And I guess myself as well, I've kind of been sitting on the sidelines a bit for the last 6 months, a year, and thinking, okay, like this kind of economy hasn't made sense for quite a while now, and the only thing I could really understand would be like an inflation trade. Now I've gotten a bit more active as there's been so many opportunities already, and I think there's going to be a lot more to come. Global trade and the energy demand in general is going to slump here as a result of the coronavirus. So I am interested in oil companies, but be very careful wading through them. They have so much debt, and we don't know how long this is going to last for. So make sure those companies can survive this. With a sky high volatility or fear index right now, the VIX, I love selling like puts on things that I want to acquire, and also looking for a decent ROI on my money while I wait to see this out, and then I decide to buy things. So it's kind of getting paid to wait. I think it's useful to remember that in the short term, markets are a voting machine, and right now the sentiment is really bad, or people are scared, so they're going to be selling everything. But in the long term, the financial markets, when they run efficiently, are a weighing machine, which means they should reward value, or good investment decisions, or good like profits. But in the short term, anything can basically happen here. The longer and more severe the corona crisis gets, the more the government and the central banks are going to have to do to regain confidence, to get the business cycle rolling, and to kind of get out of this deflationary environment and get back to what they want, their ideal like 2% inflation targets. So yeah, if you're anticipating, like I am, that the coronavirus cases right now, which are like at 150,000, are going to go to 1 million or way over that, things are going to get ugly here, and a lot of people are going to be in really, really like hard situations with work, with jobs, making ends meet. Like, if you think that, then definitely you should like stay very vigilant here, be sitting on more cash, and be hustling. Like, I'm hearing a lot of people like, oh wow, I just rewatched all this Netflix, or I'm bored, or what do I do right now? I'm like, well, you could be hustling. Like, this is like a Great Depression kind of 1929 scenario potentially, and you should always be protecting like your clown side, your downside, as far as like how far things can go down with your lifestyle. Like, stay anti-fragile. So it's like in a crisis situation, be learning, be looking for opportunities, be looking at things to buy. Don't like sit around and be like, how can I kill time? I'm bored here, I'm quarantined in my house, so we're not allowed to go out, or school's canceled. Hustle, let's get them. So yeah, stay vigilant, be careful, as there's no precedent to what we're seeing now. This is the black swan of black swans, with the debt on the books, the global economy literally grinding to a halt with lockdowns. So yeah, be careful, and best of luck.